Today, we're diving into a really fascinating shift in crypto investing. We're moving beyond just buying and holding and into a world where your crypto can actually start paying you an income.
Okay, so here's our game plan. First, we'll look at the old way crypto ETFs used to work. Then, we'll get into how this new income-generating version functions. After that, we'll really break down the risks and the rewards. And finally, we'll talk about what this all means for the future of crypto investing.
I mean, think about that for a second. This question is really the core of what we're talking about today. For so long, crypto was all about the price going up. But what if it could also be a productive asset, something that generates a real return while it just sits in your portfolio?
To really get why this is such a big deal, we've got to start with the basics. Let's look at the standard, plain vanilla way of investing in an Ethereum ETF.
For years, if you bought into a product like BlackRock's iShares Ethereum Trust, you might know it as ETHA, you got one thing: exposure to Ether's price, and that's it. You were basically just along for the ride, and this huge feature of the Ethereum network, its ability to generate its own yield, was just completely left on the table.
But now, a whole new type of product has hit the scene, and it's changing this dynamic completely. It turns what was a passive holding into something active, something that can actually generate an income.
And this right here is the game changer. Funds like BlackRock's new ETHB don't just hold Ethereum, they put it to work for you. So you get that same exposure to the price, but now you also get a slice of the rewards that the Ethereum network itself is generating.
So, you're probably asking, how does that even work? Well, it's all about a process called staking. The easiest way to think about it is this: you're helping to run and secure the Ethereum network by pledging your assets. And for providing that service, the network pays you back with rewards. It's kind of like earning interest in a savings account, except instead of a bank, you're helping to secure a massive global blockchain.
Okay, so how does an ETF manage to take this pretty complex technical process and just turn it into simple cash in your pocket? Let's get into the mechanics.
The beauty is, the ETF handles all the tricky stuff for you. You can see the flow here. First, the fund buys Ether. Then, it stakes a big chunk of it on the network using professional partners called validators, like Coinbase. Those validators do the work to secure the network, and for that, the network pays out rewards. The ETF collects those rewards and then, finally, passes them on to you, the investor.
Now, if you look at this chart, you'll see something interesting. The fund doesn't stake 100% of its assets. It keeps a little bit on the side, unstaked, in what they call a liquidity sleeve. And this is super important because it allows the fund to handle redemptions or pay fees without getting stuck in the delays that can sometimes happen when you try to unstake crypto quickly. And here's what it gets really good for you, the investor. This chart shows that the vast majority of the rewards earned, we're talking around 82% in this example, go directly to you. The rest just covers the fees. And these payouts usually show up as cold, hard cash right in your brokerage account every single month.
So what does all this boil down to in your wallet? Well, after all the fees are paid, investors in a product like ETHB can currently expect to see a net annual yield somewhere in the neighborhood of 1.9 to 2.2%, all paid out from these stake-in rewards.
But of course, that extra income doesn't come for free. Nothing ever does, right? Staking introduces a whole new set of trade-offs, and it's really crucial to understand what the risks are before jumping in.
The simplest way to think about the choice you have now is this. Are you just a pure price speculator, only betting on the value of Ethereum going up? Or are you more of a total return investor, someone who wants to combine that price potential with a nice, steady stream of income?
This table lays it all out pretty clearly, using BlackRock's two ETFs as a perfect example. On the left, you have the non-staking fund, ETHA. Simple. Your main risk is just the price of Ether going up or down. But on the right, with the staked fund, ETHB, you see you get that extra 2-ish% yield, but you also take on new risks that are tied directly to the staking process itself. And it's so important to get what these new risks are. Take slashing, for example. That's a penalty where the fund could actually lose some of its crypto if a validator messes up. Then there's operational risk. You're depending on third parties to do their job right. This is exactly why firms are offering two separate funds now, so they can match different investor appetites for risk.
Okay, let's zoom out for a minute. Why does this one new type of product matter so much in the grand scheme of things? What's the big picture here?
Well, for one thing, the market is definitely paying attention. BlackRock's staked ETF pulled in $15.5 million in trading volume on its very first day. You know, for a brand new kind of niche product, that is a really strong signal that investors are interested. But the real significance is that the world's largest asset manager has basically just created a blueprint. They've figured out how to package the complicated world of staking into a simple product you can buy in a regular brokerage account. And that right there paves the way for similar income-generating ETFs for other cryptos, like Solana or Cardano.
And BlackRock isn't exactly tiptoeing into this market. Just look at this chart. Their promotional fee is so much lower than their competitors. That kind of move puts immediate pressure on everybody else in the space to lower their costs, and that ultimately is a huge win for investors.
This quote from one of the heads at BlackRock really just nails their mission. It's all about building new, easy-to-access ways for traditional investors to get involved with the crypto economy, moving beyond just tracking a price to actually participating in the network.
And that leaves us with a pretty big final thought. As Wall Street gets better and better at packaging these native crypto features, like staking into simple ETFs, is crypto finally becoming a mainstream income asset? The line between a speculative tech investment and a stable, income-producing one is definitely starting to get blurry. Some people are even starting to call it the internet bond.